This is John Sadler, and welcome to our video on how to survive the dreaded audit. The audit is the final word on the true cost of your workers' compensation and general liability. It's critical that you understand the mechanics of the audit and that you prepare for it throughout the entire policy year so that you don't make costly mistakes that can result in your getting slammed with a huge audit bill that can be thousands of dollars and even higher. I've seen builders get hit with unexpected audit bills exceeding $20,000. Let's cover some of the basics. Both your work comp and general liability policies are subject to audit. You may also have a builder's risk policy that's subject to audit, but that's a topic that we'll take up on a different video. Under both work comp and general liability, the risk of loss fluctuates with the amount of work that's performed by a builder. The more work, the greater the risk of a claim and the corresponding need for your insurance carrier to collect more premium. The insurance industry figured out that the best way to account for the risk of claims and the corresponding need to collect premium is to tie them both to payrolls paid to employees and amounts paid to uninsured subs. In addition to these factors, the general liability policy also tracks amounts paid to insured subs, as well as the number of rental dwellings and acreage of vacant land and real estate development property. Because no builder knows for sure the amount of work that he'll perform over a 12-month policy year, the work comp and general liability policy premiums were designed to expand and shrink to take into account the actual work that ended up being performed during the 12-month policy year. This way, both the insurance carrier and builder get exactly what they deserve in terms of matching the risk of loss with the premiums that are paid to offset such risk of loss. When you meet with your insurance agent to either start a new policy or to get a renewal quote, he'll ask you to estimate your payrolls, amounts paid to uninsured subs, amounts paid to insured subs, and so forth. Based on your estimates, the agent provides a quote, and when you accept the quote, your policies are issued based on the work estimates that you provided. After the policy year ends, you're audited to determine your actual payrolls, amounts paid to uninsured subs, amounts paid to insured subs, and so forth. Next, you're presented with a final audit bill which compares the estimates that you've already paid for against the actual figures. You'll either get a refund if you've overestimated, or you'll owe an additional premium if you underestimated. Just a word of caution here. Some builders like to intentionally underestimate their work projections on policy setup to play a cash flow game. However, this is dangerous because such builder may not be able to pay a large audit bill that will be due in full within 30 days of receipt. This will result in cancellation of the existing policy as well as dealing with collection agencies. Once you've been canceled for non-payment of premium with one carrier, it's unlikely that any other carriers will want to voluntarily insure you. Taking a risk to gain a cash flow advantage doesn't make sense in my opinion because almost all carriers offer low or no interest rate payment plans that will allow the builder to spread the insurance cost over many months. Also, many work comp carriers now offer a monthly self-reporting form so that premium payments can be matched to the exact amount of work that's performed on a monthly basis. The audit appointment is typically scheduled 1 to 2 months after your policy has expired. When the auditor calls to schedule an appointment, please return the phone call promptly, even if you're not ready. It's not a good idea to aggravate the auditor as they hold a lot of discretionary power and can make your life difficult. If you fail to get in touch, the auditor can inform your underwriter, and your underwriter can cancel your existing policy. In addition, the auditor can actually perform the audit without you and can jack up your existing payroll and subcontractor figures by an assumed amount, such as 15%. You'll then receive a final audit bill based on this amount. There are two types of audits. The first is a self-audit or voluntary audit where you receive a form in the mail that you complete indicating the payrolls paid to all employees by classification code as well as amounts paid to all uninsured subs by classification code. The form is sent back to the insurance carrier and they send a final audit bill based on the numbers you reported. Most insurance carriers that insure builders don't use a self-audit because they're afraid that some builders will underreport their building activity. During a physical audit, the auditor from your insurance carrier shows up in person to review your records and to ask questions. The auditor may either be an employee of the insurance carrier or a contract auditor who works for an auditing company. Some auditors show up with a laptop that they use to directly input information, and they can actually provide the results on the spot after the audit has been completed. However, in many cases, the builder must collect additional information to forward to the auditor before the audit can be completed. A common example would be when a certificate of insurance given to the auditor shows that the policy expired prior to the payment being made for a sub's work, and the builder must collect an updated certificate from the sub. Another common example occurs when a builder must go back to the sub to get an exact breakout of material versus labor on an invoice. The audit can take place either at the builder's office or at the office of the builder's CPA or bookkeeper. Regardless of where the audit occurs, it's critical for an owner or manager to be present to answer questions about specific invoices or the type of work that was performed by each employee or sub. Oftentimes, your in-house bookkeeper or outside CPA won't know how to answer all of these questions, and it can result in misclassifications that cost you money. Depending on the degree of readiness and preparation on the part of the builder, the length of time to complete the audit meeting typically ranges from 1 to 3 hours. It can last even longer for large builders with complex operations and multiple business entities. Most auditors want to perform your audit as quickly as possible and move on to the next job to get their quotas in. If you're prepared and cooperative, they'll often help you and give you advice on what you can do to save money. In many cases, if you're a new builder and didn't understand exactly what you were supposed to do with your records, they may be lenient on your first year's audit. On the other hand, if you're not prepared and are uncooperative, the less professional auditors can make your life difficult by not giving you the benefit of the doubt on certain interpretations regarding classification codes or on labor versus material rules. This can result in thousands of dollars in additional audit premiums. When reviewing your books to extract needed information on payrolls and amounts paid to subs, auditors generally want to review both your summary records and your source records. Auditors prefer to work from summary records, whether computerized or manual, because this makes their job easier. Summary records tend to be more legible and pre-categorize the payrolls and amounts paid to subs by the type of work performed. However, auditors also want to access the source records to perform periodic spot checks to make sure that the summary records are accurate. Most builders use QuickBooks or a similar program that produce very nice summary reports for both payrolls paid to employees and amounts paid to subs. If the builder isn't automated, the auditor will want to review manual summaries such as cash disbursement journals or general ledgers. If neither automated nor manual summaries are available, the auditor will be forced to use source records such as checkbook registers or bank statements. Forcing an auditor to pore over tedious source records can be a big mistake, as they're often not legible and they can more easily lead to misunderstandings, resulting in classification errors that can cost you money. In addition, you'll need to provide certificates of insurance for each sub to prove that they were insured at the time they performed work for you. This means that you might need 2 different certificates of insurance for each sub, since their policies might expire while they're in the middle of a job. Also, if your certificate of insurance looks suspicious to the auditor, he may call the insurance agent to verify. Your auditor will want to verify that you're being honest about the employee and sub figures that you're showing on your books. They do this by comparing your books to what you report to the federal and state government on your tax records. For verification of payroll, the auditor can use your 941s or your W-3. If you don't have employees, they'll want to verify by looking at your last year's tax return for the Schedule C. For verification of your amounts paid to subs, the auditor will want to see your 1099s and your 1096 summary. For builders that don't issue 1099s to corporations and LLCs, the auditor will need to supplement this with your vendor list. It's very important that your payroll records break out overtime or double time, as you should only be charged for regular time on your workers' comp and general liability audit. Severance pay and sick time should be broken out as well, as these are not chargeable. The division of labor rules allow you to split out the payroll of an individual employee who performs more than one type of labor into separate classification codes. This can save money if one class code is less expensive than the other. However, your records must show the exact amount of hours in payroll allocated to each classification code. The auditor won't accept a mere estimate on a percentage breakout basis. Also, be aware that you're not allowed to split payroll for an employee into non-labor classification codes such as clerical, outside sales, driver, or executive supervisor. It's also very important that your subcontractor invoices break out the amount that's paid for labor versus materials, since you should only be charged for labor on uninsured subs. This is called the materials credit. If the original invoice did not include this breakout, you should ask your sub to recreate the invoice to show the breakout. If you can't get your sub to do this, your auditor can estimate the percentage breakout at his discretion. Many auditors follow rules of thumb and will generally allocate 50% or more to labor in most cases. For example, in the case of a painting sub that supplies the paint, many auditors will assume that 75% of the total cost should be allocated to labor, since the paint is relatively inexpensive. However, a different rule of thumb is used for subs that provide heavy equipment, such as for excavation or land clearing. Many auditors will allocate 33 1/3% to labor in these cases due to the high expense of the use of equipment. The auditor will ask a number of questions about your business entities, ownership percentages, operations, changes in your operations, and the states in which you're operating. If your operations have experienced a temporary increase in work due to a one-time job, you need to let the auditor know so that a note to the file can be made. Otherwise, once the underwriter reviews the audit, the underwriter may want to increase the projections on your current policies, which could result in midterm additional premium endorsements that aren't justified. The auditor will want to know the type of work performed by each employee and uninsured sub. Just because your records have a job description or the classification code of an employee or sub pre-labeled does not mean that the auditor will blindly accept this. The auditor may ask follow-up questions about the employee or sub to make sure that he agrees with your classification. As we've discussed in other videos, classification can be tricky. The two biggest classification problems experienced by builders are the proper use of the residential carpentry and executive supervisor class codes. Some auditors take the position that they want to get as much premium as possible for their insurance carrier. As a result, they may look to enforce the classification rules to the letter of the law, even if they seem unfair to the builder. Residential carpentry is generally a very expensive class code for workers' compensation. The National Council on Compensation Insurance, which is also known as NCCI, has a classification rule which indicates that residential carpentry is to be used by an insured that is a general contractor for all carpentry operations at a job site, including framing, siding, roofing, interior trim, wallboard, and hardwood floor installation. Also, the governing classification rule says that residential carpentry must be used for inside cleaning and yard debris removal in most cases. If you do not deduct the proper rate for these types of uninsured subs, you'll be in for a rude shock upon receiving your final audit bill. Not all carriers will follow the strict NCCI rules, but you need to be aware of how your carrier will handle this situation to prevent a problem on your audit. Let's shift attention to the classification code for executive supervisor. This is a very favorable class code for an owner of a building company because the cost is much less than the residential carpentry classification. For example, in South Carolina, one carrier's current rate for executive supervisor is $3.73 per $100 of payroll, whereas their rate for residential carpentry is $19.51 per $100 of payroll. The classification rules published by NCCI are a bit strict on when the executive supervisor classification can be used, and the auditors often try to force what I consider to be true executive supervisors into the more expensive residential carpentry classification. Under the technical classification rules, an executive supervisor spends his day arranging for delivery of materials, scheduling subs, and briefly visiting each job site no more than once per day to inspect the work of the subs. This is a brief summary and oversimplification of the rule, but I think you get the point. If you tell the auditor that your executive supervisor spends a lot of time on the job site and that he personally supervises the work, he'll be reclassified as residential carpentry, and this will cost you a lot of money. Shortly after the completion of your audit, you'll receive your final audit bill from your insurance carrier that will indicate if you owe more money or get a refund. If you owe additional premium, you have 30 days to make full payment. If payment is not made within 30 days, the insurance carrier can instigate collection proceedings for your audit, and in addition, they can cancel your current policies. In other words, time is of the essence. If you're going to dispute your audit, you should notify your agent in writing within 2 weeks of receiving your final audit bill. When verifying your audit for accuracy, you should always request a copy of your audit worksheet. Your audit worksheet is the detailed record of your audit that indicates the information that the auditor collected, including payrolls for each non-excluded owner by class code, payrolls for each employee by class code, and amounts paid to each uninsured sub by class code. Your auditor will not automatically provide a copy of the audit worksheet to your insurance agent due to privacy law concerns. However, if you want your agent to assist you in verifying your audit and in correcting mistakes, you should always request that the auditor forward a copy of the audit worksheet to your insurance agent. When checking your audit worksheet for mistakes, there are several types of common errors that you need to be on the lookout for. The first is when a payroll charge is incorrectly made for an owner who's excluded under work comp. The second is when the wrong classification has been assigned to an owner, employee, or uninsured sub. The third and most common is when an insured sub is being charged as an uninsured sub. This is easily correctable by collecting the certificate of insurance for the sub and forwarding it to the auditor. The fourth is when the auditor allows an inadequate material credit when the sub's invoice doesn't break out labor versus materials. This should also be easily correctable by asking the sub to provide a detailed breakout on an updated invoice. The fifth and final common error is a math error when the audit worksheet shows an incorrect number for a payroll, amounts paid to an uninsured sub, or amounts paid to an insured sub. Or there can be a math error in totaling a row or column. If you bring any of these errors to the attention of the auditor and can substantiate your argument, the auditor will be glad to correct any mistakes. After interviewing 2 auditors with over 50 years of combined experience, I've come up with this list of the biggest audit mistakes to avoid. The first is overall lack of preparation and record keeping. Preparation and proper record keeping start at the beginning of the policy year, and you can't put this off until right before your audit. If you don't know the audit rules up front, and if you haven't kept proper records, you'll likely get burned on your audit. This is exactly why I produced this video. The second is that you should maintain summary documents on your payrolls and sub-expenses and should not totally rely on source documents like checkbook registers. Auditors hate reviewing checkbook registers, and their frustration can lead to incorrect assumptions. The third is that you should never commingle your personal expenses with your business expenses. This makes for an auditing nightmare, and the auditor will likely pick up personal exposures that were not even insured under the policy. Next is being uncooperative with your auditor by missing appointments, not being prepared, or by being combative. Some unprofessional auditors will likely hold such actions against you and will be less willing to give you the benefit of the doubt on matters relating to classification and material credits. Perhaps one of the most important mistakes to avoid is for an owner to not be present during the audit. It is unlikely that your back office support person or your CPA will be able to answer all questions related to what type of work is being performed by each employee or sub. Next, be sure to take advantage of payroll credits such as overtime, double time, sick time, and severance pay. Next, know how to take advantage of division of payroll rules to save money where a single employee performs different duties that have different classification codes. Next, make sure that you collect valid certificates of insurance from all subs prior to paying them. And finally, make sure that all invoices break out labor versus materials. Hopefully, you found this video on how to survive the dreaded audit to be a benefit. Plain and simple, if you know the rules up front and have a plan to deal with them and execute the plan, you'll save a lot of money and grief. Please call our office if you have any questions concerning how to prepare for your audit. Thanks for your attention on this important topic.